Hello and welcome. You're watching News9. I'm Shweta Kothari. We're bringing you stories from the world of business, policy and economy. To my left is my colleague Suyash Maheshwari. Suyash, good afternoon.
Good afternoon, Shweta.
Markets closing 0.5% higher once again, second consecutive trading session.
As we have been talking about, in the last few days, the movement has been of days of 0.5%. We see 0.5% rise, 0.5% fall, and the trend continues. Indian markets extended their winning run to about 2 sessions now. The markets ended 0.5% higher. Nifty also managed to scale that. Nifty opened above the 19,600 levels. It closed above the 19,650 levels and gained about 107 points, whereas Sensex was closed marginally below the 66,000 mark, and it was up about 364 points or so at close. Whereas also the broader market, Shweta, were buoyant today. We have seen some correction in the mid-cap space, and over the overall breadth of the mid-cap basket has also reduced. But today it was across the board rally, and Nifty mid-cap 100 was up about 0.6%, whereas the small-cap index gained about 0.8% in today's trade. We saw a reduction in volatility also, and the India VIX index came down by about 5.5% and currently stands at about 10.33% or so. Now, among sectors, Shweta, realty was a top gainer in today's session. It's a rate sensitive sector, and RBI maintaining the rates will augur well for the demand, as the mortgages won't go up. And also we are seeing a rebound in the housing market, because the demand has gone up significantly, whereas supply has not been able to match that increased demand. And we are also seeing housing prices have gone up by about 5 to 6% in some of the metro cities, and premium housing has also picked up. It is actually outperforming the priced houses. Affordable houses. And
not so much lower price, come to think of it, below 50 lakh rupees.
Yes. Another sector that posted strong gains today was the auto pack. It was up about 0.5%. Another sector which is rate sensitive, so perhaps RBI maintaining the 6.5% interest rate has augured well for auto stocks. It was up about 0.5%. The metal pack rallied by about 0.5% on the back of a fall in crude prices. And Bank Nifty, Shweta, Bank Nifty saw a significant uptick in the intraday trade, where the banking pack was able to scale the 44,500 mark. If you remember, just a couple of days back, the banking pack had slipped below the 44,000 level for the very first time since September 1. So we have seen a good rebound in a matter of couple of days in the banking pack, and it has surged about 500 points or so. Although we saw some correction, near the end in the last hour of trade or so, and the banking pack ended at about 44,300 levels. I think all the stocks, all the sectoral indices in today's session ended the day in the green. The only sector which was under pressure was the media pack. The media pack closed on a flattish note. It was down about 0.02%, but the media pack has also run up significantly. A lot of media stocks have performed well in anticipation that that it will see increased viewing, given that the festive season is coming up. So a lot of holidays for Indians, wedding seasons out there, and then we also have the ongoing Cricket World Cup. So all that has augured well for media stocks, but today we saw some sort of a profit booking there.
All right, so that of course is the lowdown of how entire Dalal Street performed on Friday's close. But let's also quickly get into Bandyopadhyay joining us on the show. Is the group chairman of Indie Trade Capital. Sudip, thanks very much for taking time out, sir. Thank you for coming back to News9. I want to first begin by asking, what are you making of the volatility in Dalal Street? I mean, 0.5% up, 0.5% low. We've seen this happening over and over in the past 1 week.
Well, I think I would say this is, in a way shows the strength of Indian markets. Global markets haven't at all been supportive. And the way the US bond yields have been moving up, I think, one would have expected that Indian markets will suffer, but it hasn't happened. Also, look at the, FII sale data. They have sold heavily in the entire month of September. And in spite of that, I think Indian markets have withstood and kept moving, inching upwards, I would say. Some amount of volatility at elevated levels is expected, and that's what is happening. I also would like to add that, Indian markets have run up. There's no denying of the fact that we have moved up quite a bit from where we were, say, 1.5 years back. And after this kind of a rally, little bit of consolidation at around 20,000, between 19,000 and 20,000 level is probably a healthy sign because, after consolidation, there may be one more big move coming in the near future, maybe around Diwali time. I won't be surprised if we see a bit of correction in mid cap and small cap and a rally in some of the deserving large cap stocks.
All right. What is the near term? I mean, we've spoken to various analysts, experts, and we're trying to understand whether Nifty is going to scale up to 20,000 first or drop down to perhaps 19,000 first. Which of the two events do you see playing up in perhaps next couple of weeks?
See, one thing which I will point out is that today US jobs data later in the day will come out, and that will to an extent determine the mood of the US markets. It's a peculiar scenario. What is ideal for the market is not too hot, not too cold. Like one says that my tea should not be too hot or too cold. So it's like that. Jobs data should not be too good, should not be too bad. If that kind of situation remains, I think Indian markets will derive support and probably will move across 20,000 next week itself. However, if on the other hand, if we have a jobs data which is not supportive of what I explained, I will tend to think that markets will continue to hover in this range, as you rightly described, 0.5% up, 0.5% down. That's what it will keep doing.
Okay.
Also remember that IT results will start coming out. So some amount of domestic cues will get derived from the IT results as well.
Okay, IT is a different story altogether. I mean, the kind of story that's playing out by the way of commentary that is coming in from, various brokerages is going to play up heavily on IT stocks. But before we move to that, I think, Suresh, it's interesting to point out, Sudip says anything lower or higher when it comes to jobs data will not augur very well for the markets. There has to be a median, not too high, not too low.
I mean, as far as the US markets is concerned, we have seen that the dollar index has surged to, I think it's currently at a 10-month high or so. And in fact, early in the morning, we saw that there was a correction in crude prices. There was a slight bit of correction in the US bond yields. But the third major factor that has been, pulling the markets down was the dollar index, which has not really eased as much. So, economic data coming from the US is also very important because it will give us cues as to what Fed's decision will be. I mean, if the economy continues, the US economy continues to run hot, Fed may perhaps go for that extra rate hike that, Mr. Powell talked about in the last policy meet. If that doesn't happen, perhaps we can see, that it will maintain rates over the next couple of policy outcomes that are due this year. And perhaps that's one of the reasons that, the Indian markets will also track that what's going on in the US markets. Anything, above expectations will not augur well for us because the yields will also spike up given that, inflation is running hot and the expectations of a rate hike will also, strengthen significantly.
Right. So it doesn't work for us either ways, if it's too low, if it's too high. But on crude prices, the crude prices have corrected significantly, Sudip, over the past couple of days after a run-up of at least $8 to $10 back to below $85 a barrel as far as Brent latest is concerned. How does that work out and what's playing up on crude prices? I was reading somewhere very interestingly that despite the OPEC production cut, the demand just hasn't picked up. What does that tell you as far as consumption is concerned in the US and various developed economies?
Well, I think I must say that this is a great news for India. India is 80% of our requirement still gets imported. So crude oil prices coming down below 85 from where it was kind of touching 100. I think it's a fantastic news for Indian economy, Indian balance of payments and Indian capital market. So let's first put that right across. The other issue why oil prices are coming down, I would say that, look, I think the OPEC and other oil producing countries have been trying to push up and keep the oil prices up. But the reality is that demand hasn't been really strong. And one principal factor, the way I look at it, is the weakness in Chinese economy. I think Chinese economy not picking up on the expected lines have been one of the principal factors of crude not sustaining at elevated levels. Of course, US reserves getting released periodically does cool off the oil prices, and also the fact that the way the European economy and even US economy is shaping up, I think there probably will not be too much of chance of crude going above the current levels. So our guess is it will hover between the 75 to 85 kind of a range for a considerable period of time. Also remember that the Russia-Ukraine war, which has forced Europe to move away from crude oil to other alternate energies, will have a long-term impact on global oil prices. I'm not saying that will have an immediate impact, but definitely that will have a long-term impact on crude oil prices.
So what's your outlook on the realty pack? Now we saw a 3% rise in Nifty realty today, and there are also reports suggesting that the demand for houses is expected to go up, whereas the supply has come down significantly, and as a result we are seeing a significant bump up in prices of both premium housing and affordable housing. What's your overall outlook on the Nifty realty pack?
Well, I have been positive on Nifty realty and select real estate stocks. I think you're absolutely right in saying that demand for premium housing has been strong. And the basic reason also you have put across rightly is that the supply, there were oversupply. When we went into COVID, there was serious oversupply, and pretty much the entire sector was plagued with that oversupply challenge, and the prices were not going anywhere. That scenario has corrected. New projects haven't come up at the pace at which demand has increased, and that has led to a situation where I think the demand is outstripping supply as far as premium housing is concerned, and that has led to prices inching up as far as premium housing is concerned. And also the fact that new project, even if they are launched now, will take a lot of time to come up, is enabling the builders to kind of really get a good value for ready property or near ready properties. The other factor I would also definitely like to put here is that the entire sector has cleaned up quite a bit, and we should not lose sight of that. The way the real estate sector in India was operating, let's say even 5 years back, it was kind of Wild West. From there, I think GST came in, RERA came in, Ind AS, the accounting standards got streamlined, and all these have actually made the investors have a lot more confidence in the balance sheets of real estate companies. Also the fact that unrelated diversification, wherever the companies had made, they went out of that, and that also did made them look better in the eyes of investors. I think all this put together have really worked wonders. Last point I also must make here is that the introduction of REIT, real estate investment trusts, also is an avenue which real estate companies having commercial properties or building commercial properties received, which should in the long term introduce a new avenue of funding as far as these companies are concerned.
Now, sir, before we move on to the stocks that were in the news in action today, I also want to touch on JSW Infra. Now, the stock has rallied about 42% since listing, and even today the stock was up about 4%. What's your view on the stock, sir? Is it time to, for investors who are allotted shares, who were in it for the listing gains, is it time to exit the stock or book some partial profits?
I think it's a good company, first of all, let me say that. And I think it's in a segment where it's not a capital intensive business. And it has a lot of growth path. Building ports and terminals is a fantastic business, and if India infrastructure build is happening the way it is happening, I think they would continue to do well. Initially, when they started, it was a captive business for the JSW group, but they have diversified, and the I think objective which they talked about in the pre-IPO is very clearly to diversify more, and JSW business will become probably a small part going forward. I think all these are good things. The company is doing good. It's not a new company. It's an established company, profitable. But having said all that, I also must say that the valuation at which they came was kind of appropriate. It was not overvalued. There was something left on the table for the investors, and pretty much that got played out over the last few sessions, where the price has moved up quite a bit from the IPO price. But at this stage, I would say that probably it's time to take a pause, and some amount of profit booking definitely should be recommended to the investors who have got the shares.
Now, sir, if one were to invest in a port operator business, what would be your pick? Adani Ports or JSW Infra?
Well, if I have to invest in one of these, I think I will go for Adani, because it's a much wider basket, and the way they have built their business, I think I'm not getting into the the ownership, the challenges, all those issues. These are irrelevant to the context of Adani Port, because it has solid assets on ground. If you look at Indian Western seaboard as well as Eastern seaboard, systematically they have accumulated assets both on Western as well as Eastern seaboard. Now, this gives them a fantastic position as far as Indian economic activity is concerned. If India is growing at 6.5%, 7%, or even closer to 8%, 9%, or maybe 10%, which we all wish, I think import and export both will flourish. And if that happens, I think Adani Port definitely will flourish in a big way. So if I have to pick between the two, I think I will go for Adani Port at this stage, considering that India shining, or India development, or India infrastructure push is real and is happening now.
Okay, Adani Ports it is. But also let's quickly talk about some of the stocks that were trending in news this afternoon.
Yes, Shweta. So among the top gainers in the blue chip segment was Bajaj twins. Both Bajaj Finance and Bajaj Finserv gained significantly. In fact, Bajaj Finance touched a new 52-week high. Now, this was on the back of Bajaj Finance's board approving the 10,000 crore QIP. And we saw some rub-off effect on Bajaj Finserv as well. Now, Titan was another stock that gained around 3%, as the company is looking to expand its wearables business that is housed under the Fast Track brand and the Titan brand. Another stock that gained was IndusInd Bank. Now, Motilal Oswal has come out with a report where it has picked IndusInd Bank as its top pick. The Motilal Oswal has raised the target price on the stock to about 1650, which implies an upside of about 18% or so from current market price. Tata Consumers also gained about 1.5% or so after the company said it aims double-digit business growth in the coffee business, led by expansion in both portfolio and in reach. Now, among losers, Shweta, the top loser in today's segment was HUL. HUL, in fact, has been in a bit of a bull run. The stock has rallied about in the last 4 sessions. Today, it snapped that winning streak and saw a correction of about 0.8%. Coal India is another stock that has been on a bullish trend, has run up about 30% or so in the on a year-to-date basis. But the stock has been seeing some profit booking, and it has corrected by about 2.5% in a matter of 5 days. Another stock that saw some profit booking take place was ONGC. Now, ONGC is an upstream company. That means it is in the it is in the business of production and exploration of oil, and since crude prices are softening, companies like ONGC obviously take a hit, and as a result we are seeing some profit booking there. Now, Asian Paints is a surprise inclusion among the top losers. Generally, softening of crude prices bodes well for the company, because crude is an essential raw material for the company, and in fact it was one of the reasons why the stock was under pressure, but it continues to see some profit booking, perhaps on the back of expectations that the competition will increase. Bharti Airtel also failed to cheer the investor sentiment, despite it launching plans that were focused for cricket fans ahead of the World Cup.
All right, those of course are top gainers and losers on Dalal Street this afternoon. Sudip, before I let you go, any stock that stands out for you?
Well, there are multiple stocks which does stand out. I think one company I must mention is amongst the large cap is Reliance Industries. I think this is one stock which has got multiple levers and multiple value unlocking opportunities going forward. Whether it's the retail where they're talking about IPO or something like that in 25 FY25. They have the entire platforms business, which is the telecom business, which also will get unlocked at some point in time. The green energy business, which is developing inside Reliance Industries, is another area where some value unlocking will definitely happen in the near future. Considering all that, I think the stock hasn't run up at all. And investors should do well picking up this stock for long term as far as large cap is concerned. Also, I must mention that HDFC Bank, I think this is one bank which has lost quite a lot in peer comparison terms as far as share price is concerned. But things are getting better and better as far as HDFC Bank is concerned. And investors will do well to pick up HDFC Bank at these rates. Amongst the other sectors in the market, I like textiles. India-UK FTA, I think it's a matter of time before it gets signed. And if that happens, some of the textile companies will be the biggest beneficiaries. I can talk about Gokaldas Exports. I think definitely they will benefit. I can talk about Arvind Limited. It will benefit. So I think some of these stocks definitely are worth considering at this juncture.
Okay. Well, Sudip, time to move on from, stock market specifically to a big story that we are tracking, coming in by the way of Reserve Bank of India's announcement of fourth bi-monthly monetary policy today. The RBI governor-led MPC maintained status quo on rates and its stance. The MPC decided to unanimously keep the policy repo rate unchanged at 6.5%. The MPC also decided to remain focused on withdrawal of accommodation to ensure that inflation progresses and progressively aligns with the target of 4%. Among other key announcements, RBI retained the GDP growth forecast or projection for financial year 24 to 6.5% and inflation forecast at 5.4%. Let me quickly get in my colleague Krishna Kumar, who's also joining us. But Sudip, before I let you go, quickly on inflation, RBI says that inflation, Krishna is also here. Krishna, please do come join us. Sudip, before I let you go, inflation at 5.4% for financial year 24. Do you agree with that estimate, given that the month of September hasn't quite augured well, at least for Kharif crop sowing and as far as, inflation in rural areas is concerned?
Well, I think, the reports as far as sowing are concerned is mixed. And there's a strong expectation that during the winter, the food grain prices and food prices will come down. And that should, to an extent, bring down the inflation. Also, there were worries around global oil prices when they were touching $100 per barrel Brent. But now, since they have come down to an extent, and the expectation is that they will not probably go up, I think the inflation will remain within a manageable range, and a major flare-up probably will not be there. And that is the scenario which RBI is working on at this stage.
All right, Sudip, thank you very much for taking time out. Thank you for being with News 9. Yuvika Singhal, who's an economist at QuantEco, also joining us this afternoon. Yuvika, thank you so much for taking time out. Good to have you back on the show. Quickly, to run us through what was your key impression of takeaways from the MPC meeting today. Nothing, that sprang a surprise, everything quite in line with what was estimated, perhaps the projections.
Hi Shweta, thanks for having me here. I think yes, there were no surprises as far as the rate is concerned or even the stance is concerned. RBI maintained a status quo on both. But I think there were two things which stood out and which markets and analysts have taken note of. One, that the governor clearly said that we have to align with the inflation target of 4% and not the band of 2 to 6. So that clearly indicates that they are extremely concerned of bringing inflation back to the 4% target and not be content only by bringing it lower within the band of 2 to 6%. And second, I think something that again caught the markets somewhat on a surprise quotient was where he mentioned that they would want to actively curb liquidity via the tool, using the tool of OMO sales sometime in the coming quarters. And I think we have seen a knee-jerk reaction of bond yields rising up substantially, post the policy. But I think that's more of a knee-jerk reaction because of the comment. But I think they're pretty serious about maintaining liquidity somewhat in a neutral zone, and would probably actively use a tool of OMO to curb the surplus, liquidity surplus that we are witnessing as of
now. Yuvika, the inflation projections for the full year is set at about 5.4%. For the first quarter of FY25, I think it's at about 5.2%. So for RBI to for inflation to come in line with RBI's projection, long-term projection of 4%, I mean, it seems like the rate cut that we were expecting, probably in the earlier half of next year or maybe later this year, is it pushed back? Is that expectation pushed back?
See, I think as far as inflation is concerned, their assessment seems pretty much online. So for this year, their projection of 5.4 is almost in line with our own assessment of 5.5. What we have to appreciate that Q1 and the first half of the year, essentially when we saw price spike led by perishables, especially tomatoes, through the months of June, July, August, is likely to be temporary in its nature, and also it's a spike that can be looked through because it was largely supply driven, and we have seen prices correct at a much sharper pace. Now, going on here on, if you look at the year-end projection of CPI, and we also have now forecast for the first quarter of next year, which are both pegged at 5.2, clearly that 4% target is not in sight, at least for the next visible 4 quarters. Yes, if things were to improve thereon, if we could continue, if we see a normal monsoon next year and the price pressures, remember we are looking at a very benign core, and it's largely food and fuel, which is the non-core side of inflation, which has flared up in in the last few months, and crude, especially on the energy side, which is looking somewhat a little uneasy at this point in time. But having said so, if we see these food and fuel price pressures ease, core anyways is looking somewhat lower in its momentum, we could be gradually moving towards that 4%. Definitely not in this fiscal year, but sometime in FY25. But I think also we need to keep in mind, and RBI governor and the monetary policy members have reiterated this in the past, that what we need is surety or the visibility of inflation coming down decisively. So probably, that inflection point on the rate cycle will come in with the visibility of inflation touching 4. So we might not have to wait for inflation to touch a 4%, which is the midpoint, but the inflection point could come in sooner with the visibility. In our own expectation, we have never ever looked at inflation, rate cuts in this fiscal year. We had always said that it looks somewhat more probable either towards the very fag of FY24, but even that looks difficult to us. We have maintained, over the last few months at least, we have remained with a call that a rate cut looks only possible in the first quarter or thereabouts of the next fiscal year.
Right. In the meanwhile, you're also looking at a longer high interest rate cycle in the US, and Western economies going through what they're going through. So, by that logic, is fiscal 25 too only like a great white hope at this stage?
Well, yes, it's pretty uncertain on the global front, I think, and we've seen commentary from Fed, and they've switched gears many a times in the past when they kept calling inflation transitory. Now, once again, there's a lot of uncertainty now. While inflation has come off, crude oil prices dynamics have added to that uncertainty. We do not know what that inflection point or the peak of interest rates would be. Probably another 25. Looks like it, but it's somewhat given that higher for longer narrative is likely to take place. And if you look at the recent Fed commentary and the dot plot, the extent of rate cuts have actually been much more curtailed now. Probably they are just looking at 50 basis points of rate cuts, and that is too premised on some kind of a soft landing probably taking shape, which to date remains fairly elusive in the US economy. So if you look at a wide host of indicators, most of them have continued to display strength. There are in fact factions within the Economist which are probably talking about a no landing situation as well. And if that was to transpire, whether rates would remain higher for longer and the quantum of rate cuts that we eventually see next year will once again be back on the table for discussion.
All right, and before we let you go, Yuvika, September numbers as far as inflation is concerned, we don't have them just as yet. And keeping in view that September was a difficult month in terms of monsoon being haywire, perhaps parts of southern India, parts of western India not getting the same sort of rainfall that, was in line with the expectation. All of that could have played up on inflation numbers. What are your projections for the month of September, for second quarter of this financial year, and perhaps the overall financial year? Do you believe we will manage the 5.4% range, or is it going to be perhaps an upward of 5.4%?
So I think, Shweta, for the month of September, we are a little more optimistic, and largely because of two reasons. One, the entire, or at least a dominant part of the price correction in tomatoes, which started taking shape in the second half of August, the large part of that impact will be felt in September, because on an average basis, August prices still remain fairly elevated. It is only in September that we've seen the full impact of price correction as far as tomatoes is concerned, and that is likely to help pull down the headline inflation. The other comforting factor for September number would be the cut that we saw in the LPG prices. And remember, it was a steep reduction of 200 rupees, which could translate as much as 30 to 35 basis points of comfort coming only in the month of September. Again, remember, this was announced in the very fag end of August, and again, the entire play out will happen in the month of September when we get the readings. And it is largely because of these two reasons that we expect the September number to give a lot of comfort, and it's likely to slip below 6%. We are still working with, we're still waiting for full range of data to come out to be able to firm that number, but definitely it's going to be below 6 is what we are working with. As far as the inflation trajectory thereafter is concerned, remember Q3 is typically a quarter where the winter seasonality sets in, and typically we see price corrections on food. Having said that, we are seeing price pressures in food in certain staples such as, cereals, wheat and rice, pulses, spices. We have seen administrative measures come in from the government, but they've not had the desired impact. Remember, we'll also see the Kharif harvest come on board. So all these factors put together, administrative measures, winter seasonality, Kharif harvest, Q3 could look somewhat better with some kind of dial down on price pressures, at least food is concerned. So we do expect that glide path of trajectory of inflation moving lower should continue. The joker in the pack remains crude, definitely, because if crude was to rally again to 90, though we have seen some reprieve in the prices in the last few sessions, but if prices were to remain elevated because of geopolitics or OPEC supply cuts, then that could be something to watch out for. Although we do believe that the price impact of crude will be much higher on WPI, and to some extent much more marginal or much more benign on the retail side, largely because remember it's an election year and the government might want to absorb a certain part of the price increase if there was to happen, if crude prices were to remain elevated, or probably ask oil marketing companies to absorb some part of the price increase and probably keep the retail side of consumers somewhat, provide some comfort to the retail side of inflation and to consumers.
All right, so 5.4 it is?
Thereabouts, yes. We are at 5.5, but stacks to the upside, yes.
All right, Yuvika. Always a pleasure talking to you and listening to you. Thank you so much for taking time.
Thank you.
And moving on now, Indian IT sector is set to have a washout year of financial year 2024 is likely to be a washout, is what JP Morgan is saying. JP Morgan analysts are anticipating that investors will closely examine the forthcoming second quarter financial results and the commentary provided by Indian IT companies to decide on the future course of action. They will be searching for indication of a rebound in the numbers of deals that have been signed and will have an impact in fiscal year 2025. Now, JP Morgan analysts remain negative on the sector in absence of a meaningful uptick in demand. Remember, all major IT firms, including Infosys, TCS, Wipro, HCL Tech, have previously warned that their clients, a majority of whom are based in the US, have been lowering their IT spending, delaying and even cancelling contracts as economic growth prospects slow down on fears of higher for longer interest rates. Joining us is Barnik Chitran Maitra, Managing Partner at Arthur D. Little on the show. Barnik, good afternoon. Not so very good news coming in there. The commentary on IT pack, IT sector will not augur very well for the sector. We don't know what the impact is on the markets just as yet. I'll get my colleague Suyash to comment on that. But as far as, the prospects of IT sector is concerned, looking bleak for this year.
Yeah, I think last quarter results were also quite disappointing. I think if you just go back a few quarters back, I think FY23 was positioned as the big washout year with green shoots in FY24. However, that has not happened as the IT sector continues to battle what I would say a perfect storm, right? You mentioned new deals slow down, renewals are under pressure, and when clients are renewing deals, there is actually severe pricing pressure on the deals. On that, I think there was severe cost pressure last cycle. I think all firms reported a 150 to 200 basis point drop in margin. So FY24 looks bleak. I would be on the lookout for some green shoots towards the second half of the year, not this quarter earnings, but maybe the next quarter and the final quarter earnings for some uptick in new deals, because the outlook in the US, though bleak, is improving. I think the Fed has tapered off its policy stance. There is an expectation that rate cuts will probably start kicking in by FY25. If that happens, you will see some good news potentially at the end of this fiscal, but I think it's fast forward to FY25 for the sector to attain the growth and profitability we've used to see in the sector in the past.
Now, Barnik, I mean, the commentary, at least in the last policy meet from Fed, was that, it could look at another rate hike, possibly the November meet or the December meet. And even the narrative that came out from the meet was that, interest rates will stay higher for longer. So, where is this expectation of perhaps a rate cut in the near future coming from in the US?
No, so if you have to look at, it's not the rate cut, you have to look at the nature of spending and the people who spend with Indian IT service companies. Their two biggest sectors have historically been banking services and technology and telecom. Their largest markets have been US, UK, and North, I would say, continental Europe. I think as many people expect, despite the Fed posture, I don't think people are expecting a hard landing for the US economy. Now, what that means in terms of Fortune 500 decision making is budgets which have been cut are likely to get restored in the next fiscal for them, which, by the way, starts on 1st October for most US listed companies. So I am hearing that at least for certain areas which are actually fundamentally driving productivity for US enterprises, maybe it's on cloud, maybe it's on supply chain productivity, maybe it's on enterprise transformation, there will be a restoration of spends for US companies towards the second half of the new fiscal, which, by the way, ties in quite nicely with our FY25 fiscal year. So if you just look at how executives look at it, despite the Fed commentary, I think there is far more optimism around where the US economy will land in the next quarters. And that we are seeing reflected in conversations within US boardrooms and within decision makers. And again, it's important to see the commentary we get out of the IT firms in the quarterly earnings release next week as to what their forecast is. But I would say people are far more cautiously optimistic today than they were around this time when they were announcing the last quarter results.
Okay. The one thing I want to ask you is that what does a washout year even mean for India's IT industry? India's IT industry is leading the ignition for GDP, for the GDP of India. It is the number one sector in India, number one stock in the markets. What does a washout year mean? Are we looking at more job cuts? We're also getting news about, campus placements being cancelled. Are you looking at a reduction in job force? What does it mean for the people of India and the economy of India going forward? What does it mean for our GDP ambitions for the next year?
Well, I think the Indian IT sector has been at the pinnacle of our industry, local industry, for a long time. I think we judge them by very harsh standards, right? A washout year for them means a low single digit or a high single digit growth, revenue growth for tier one companies. Maybe it's a low teen growth for tier two players. And in general, anywhere between a 4 to 5%, if not 7-8% earnings growth for most players. I think analysts are used to getting quarter on quarter growth from these companies, have now subtly moved to year-on-year metrics. So again, remember, the bar is very high on these companies, and a washout year for them is not a year of negative growth or negative profits. said, given the fact that growth will be muted, the scale of hiring and absorption will slow. I think there are several news of players who rescinded campus offers, converted campus offers to internships, which have been there. They are a reality of the market. If your customers in the US are not spending, you cannot honor hiring commitments. But my sense is this is temporary pain for a couple of quarters. I think, in fact, the good news I expect to see next week is that a lot of the CEOs will announce that the cost pressures are beginning to subside, because most of the wage hike impact last March has already been factored in. There's a cooling in inflation in general in India and also in other markets where there's headcount. So I think the worst news in terms of layoffs, deferral of campus hiring may be behind us. Again, very careful to see the kind of commentary we get, but I think the margin pressures today are probably a little better than they were a quarter back.
Mm-hmm. All right, and Suyash, I also want to know, how did IT Pack react to that news?
So IT Pack actually, I mean, the IT stocks, the Nifty IT Pack was up about 0.67%, and it's seeing some sort of a rebound, after the correction that we saw last week.
Perhaps in anticipation of the results?
Perhaps in anticipation of the results, and also that we have seen a lot of deals that have, been a lot of the companies have landed some big deals in the last couple of months. If you look at Infosys, for example, $4.5 to $5 billion worth of deals. I mean, the revenue guidance is for multiple years, but no, they have landed deals.
The one thing I wanted to ask you is that does the market also factor in the fact that, we're talking about even if you talk about a washout year, that's going to end in March 2024, and then you've got the next fiscal beginning in April. So are, in a sense, positions built in? Because even if you look at the JP Morgan note, it says essentially that analysts across the world are already under consensus that India's IT industry is going to have a quote-unquote washout year in 2024, and hence are already pinning hopes on 2025. So is the markets already factoring in that nothing much is going to happen in that period?
Yes, I think that's exactly what played out last week, Krishna. We saw that the IT Pack came under significant pressure, especially after, Fed said that it will keep interest rates higher for longer. But we are seeing a rebound. I don't think there is a consensus there, because Morgan Stanley recently came out with a report where it was very bullish on the Indian IT Pack.
I mean, look at the size of the deals there. From Infosys to TCS, $1 billion worth deal with digital unit of JLR, and those deals, have been signed through this fiscal year.
Yeah. Through this fiscal year, and on the back of the big deals that they have landed, Morgan Stanley is bullish on a lot of these IT companies, whether it is TCS, whether it is Infosys, HCL Tech. They have raised target price, to a tune of about 25 to 30% or so. So I don't think there is a general consensus that, IT will underperform. Perhaps maybe globally, but India's IT sector could outperform at least. From according to Morgan Stanley.
All right. There's no consensus there, but I think we'll keep a close watch on how IT sector performs. Barnik, thank you so much for taking time out, for joining us with your inputs on that big story.
Yeah, bye.
We're shifting focus now. There's just one more day left to deposit 2,000 rupee note. However, as many as 12,000 crore rupees, or 3.37% of the total currency notes, remain in circulation, RBI Governor said today. Now remember, this essentially means that over 96% of the total 2,000 value banknotes are back with the banking system. Of the 3.43 lakh crore rupees, about 12,000 crore rupees is still in circulation. 87% has come back, either in form of deposits or exchange of cash with other denomination notes, RBI Governor said. So if you're holding on to that note, please kindly deposit it. You have one more day. This time there may not be a change in deadline.
Well, better not. I mean, we already have enough time has been given. You're talking about last minute wrapping up is what is going on right now. And all I can say right now, Shweta, is that fingers crossed. Let's hope that this deadline doesn't get extended anymore, because we've had a very clear indication from the Reserve Bank of India much long ago. And in the sense, we're even talking about it here on the show is because it's an appeal to all those watching this broadcast live or otherwise. Just to let you know, the deadline expires on the 7th of October. If you have any 2,000 rupee notes, now is the best time to make sure it's returned.
Now is the only time.
Now is the only time. So no more procrastination. Not on this one for sure.
All right. So one more day to go. But Let's close this bulletin with the GST Council meeting, which is scheduled for 7th of October, tomorrow, Saturday, to discuss the pending reforms agenda by the Council. The 52nd meeting of the Council will be held in the national capital. The Council is likely to review progress made by states in incorporating changes with regards to taxation of online gaming in the SGST laws, as was approved by the 51st Council meeting. Media reports suggest that the Council is likely to clarify on levy of tax on bank and corporate guarantees provided by directors and promoters of a company. The meeting will also consider exemption on millets sold in powdered form. Now, GST Council is likely to consider reducing GST on molasses to 5% from 28%, which is the existing rate, and could further give clarity to centre and industries on taxation of extra neutral alcohol, or ENA, used in distillation of alcohol. All of those could be discussed in the meeting potentially tomorrow on Saturday at the 52nd GST Council meeting. We'll keep bringing you all those details here on Newsline. Thank you for watching.